Hey there, good afternoon. Welcome to another edition of SRT Live. I'm your host, Sean Richard. Thanks so much for joining me today for your weekly real estate market update. We've got a good amount to get to today. I'm going to go ahead and pull up the Facebook group for those of you who are watching on Facebook. That way I can answer questions if any come in. All right, so I'm going to pull it up. Awesome. All right, well, thank you for joining me. Today is Tuesday, March 22nd, and wow, last week was a cluster. We had all kinds of information coming out last week, so much so that we are still talking about it this week. So let's jump in. All right, my Bluetooth headset doesn't seem to want to stay in my ear today. So let's get to it. Let's kind of talk about some data points as we normally do. And then I can get into some of the events, kind of what's going on in the market. So let's talk about yesterday and today. Yesterday we actually had the Fed president, the Fed chair, Jerome Powell, J Pow, as we affectionately call him. He came out and he was at a conference and he made some comments. He chatted about what the Fed was going to, the approach that the Fed is going to be taking going forward. He talked about being more aggressive with a potential increased rate hikes. And so we'll talk in depth about that a little bit later. So let's put a pin in that for the moment. Last week, as always, last Thursday, we got the jobless numbers, jobless claims, unemployment claims, both initial, people filing for unemployment for the first time, and then continuing, people who are renewing their unemployment claims. So last Thursday, market expected 220,000, and these are week by week. So last Thursday was for the prior week. Market was expecting 220,000 new claims. We got 214, so a slight dip. We're in the low 200,000s every week. I think we hit a point where we were in the, just under 200,000. Essentially, this just speaks to a very strong labor market, nothing that we haven't heard in the media and all over the place. And these numbers confirm that. So 214,000 unemployment claims for 2 weeks ago, essentially, from today. And then we have continuing claims. So the market was expecting 1.485 million. We actually ended up at 1.49, a slight decrease. And again, just speaking to the power and the strength of the jobs market. That was on Thursday. Last week, we also got building permits. Now, we got building permits and we got housing starts. And these are both released by the US Census Bureau, the Department of Commerce. And so these gauge permits are permits pulled for construction projects. And so this gauges the kind of the health of the real estate market in general, like the commercial world. And so the number of building permits pulled, 1.859 million, previously was 1.895. So a slight tick down in building permits, but pretty close. So I think we're still in healthy territory there. But what was really intriguing to me was the housing starts. Now, housing starts are single family or residential homes, both houses, and they call them apartments, probably like condos and things like that. And so how this measures the quantity that were constructed. And so the numbers for the month 1.769. Now the previous reading was 1.657 million. So 1.769 million, a tick up of a little bit over 100,000. And so perhaps that means we're starting to see construction accelerate a little bit. And boy, do we need it. We need construction to move a little bit faster, so that way we can get a little bit more inventory, a lot of it more inventory on the market, so that way we can have a little bit easier time helping clients get into homes. So we got that as well. And then we also got the NAHB, the National Association of Home Builders index, home market index. And so this is essentially builder sentiment. This is how confident are builders in the near term construction market. And so this is on a scale of 0 to 100. And anything over 50 shows builder optimism. Anything under 50 would be pessimism on the builder side. And so what was interesting is the previous reading, last month's reading, was at an 81. So really, really high. We've had really high numbers on this this NAHB market index for a while. But last reading, last month, 81. Last week's reading, we got a 79. And so small decline, but something to watch. I think, next month, let's get a feel for where it's at. Are builders, nervous about where the new build market is headed, the housing market from the new construction standpoint? That tick down is not a big deal unless it becomes a trend, and then we could see some challenges, or some additional headwinds, right? Because builders, they're always forecasting, and so if the builder is forecasting that the market is going to be more challenging for them, what do you think they're going to do? Well, they're more than likely going to maybe slow down a little bit. Perhaps they're going to change the way that they're approaching the market to almost brace themselves for maybe challenging headwinds if that's what they foresee ahead in the new construction market. So something to keep an eye on. Again, the small tick down, not necessarily bad, but let's see if that becomes a trend. All right. Looking ahead to this week, I've got a little bit of data coming up this week. We've got new home sales coming out on Wednesday. As always, on Thursday, we've got unemployment claims, jobless claims, so that's coming up. And then on Friday, we get pending home sales. So that's what we've got ahead this week. And so let's dive into the fun stuff. Let's talk about everything that's going on in the market. Some of this you've heard me talk about on a weekly basis, and it's constantly evolving. And so plus I like to make sure that if anyone didn't catch last week's episode, you can catch this week and still get a good chunk of the information. So one of the aspects that I've talked a lot about, and I want to show you, I want to pull this up, is I want to show you the yield spread between the 10 and 2-year treasury. So let me go ahead and pull this up for us. Here we go. I know how to share things. I was taught to share when I was younger. All right, so here we've got a number of different details. So we've got the your mortgage-backed securities. We're on the 3.5% coupon. We're down quite a bit today, but as you can see here, we're actually up from where we were earlier today. So that's a positive reversal for us midday, but still down on the day. And we kind of took a bath yesterday on it. So mortgage rates moving higher yesterday and today. And then we've got the 10-year treasury at 2.379. But here's what I want to show you. So we've got the 10-year treasury at 2.379. And we look at this 2-year treasury here, and it's at 2.15. So we've got 22 basis points, 0.22, 22 basis points gap between the 10-year and the 2-year. And you're like, great, Sean, what does that mean, right? And so think of it like a certificate of deposit at a bank. And so when you go to a bank, if you choose to invest your money in a certificate of deposit, you typically have different terms of certificates of deposit, CDs. You can do a 3-month CD, a 6-month, a 12-month, maybe a 2-year, 3-year. You've got short and you've got long-term CDs. And so typically when you're investing in CDs, which CDs pay the higher rate, the higher yield? And if your answer is longer term CDs, you'd be 100% correct. Typically, longer term CDs have a higher yield than short term CDs. And so the treasury notes, which are really just investment vehicles, are the same way. The longer term treasury notes typically yield more than the shorter term treasury notes. Okay, so now what does it mean that these are so close together? Well, I'll show you. Let's jump over here to the treasury yield spread. And we're going to look at the 2-10 spread. So the 2-year treasury, the 10-year treasury. And why this is important is because you can see right here, this is the spread on the left-hand axis here on the y-axis. I don't know. I failed geometry. So you've got the spread over here on the left, and then of course you've got the time frames down here in the bottom. And so you've got 0 right here across the middle. And that represents, any of this red that you see is an instance in history going back to 1976, June 17th, 1976. You've got a view of every instance that the 2-year treasury was above the 10-year treasury, or reverse, the 10-year treasury yield dipped below the 2-year treasury. So all of this red, every time you see red, that's exactly what happened. And on this chart, these gray bars here, these vertical gray bars, indicate a period of recession in our economy. Well, notice any patterns. Every time that we had the 10-year dip below the 2-year, we had a recession shortly thereafter. And we call this an inversion of the yield curve. So you had an inversion here, recession, inversion here, recession, inversion here, recession. We had a tiny little inversion here. Here, I'll zoom in on this. Yep, we had a tiny little inversion here in 2019, recession. Okay, so let's look at this. This is April of 2021. The spread between the 2 and the 10-year treasury was 1.51, 151 basis points. Fast forward to, let's go to a 1-year look. And as of right now, well, we saw it above, but as of yesterday, 18 basis points is the difference between those. And as of today, we've gained a little bit of ground. The 2-year is not quite, the 10 years are what, 22 basis points? See, 238, 215, 23 basis points. So we're a little bit higher today, but we're dangerously close to the 10-year yield dipping below the 2-year. And as we just saw, almost every single time, pretty much every single time in history that's happened, going back to 1976, it's resulted in a recession over the next, typically 18 months. And so what does that mean for a housing market? Because that's what we're here to know, right? What does it mean for real estate? And so what that means, what happens in a recession, right? Well, one, the economy slows down, and that's kind of that's part of the issue. We're in stagflation right now, which is the economy slowing, but we have rapid inflation. So that's stagflation, your vocab for the day. And so a recession, when a recession hits, the economy is slowing down, and home prices still typically tend to rise during a recession. They tend to, the speed at which they rise slows down, but they still tend to rise. So home prices still rising, but interest rates decline. And so what that leads us into is a potential for an amazing opportunity for a refinance boom. So for all of you out there that are looking to buy a home right now, and you're like, oh my gosh, the rates are going up, prices are going up, groceries are going up, gas is going up, and your morale is down, then fear not, because if you're able to land that home now, you're going to be in a position where you might be able to refinance over the next 18 to 30 months and take the equity gain between now and then, because home prices are still rising. So gain the equity in the short term and then refinance to a lower rate to get the long-term benefit as well. It's an ideal place to be if you're looking to buy in this market. If you're a real estate agent, have these conversations with your clients. Now, I don't have a crystal ball. I can't guarantee that we're going to be in a recession. The probability is high because of what I just showed you, and there's other indicators as well. But if I had that kind of crystal ball, right, I'd probably own my own island somewhere, and so clearly not reaching out to you from under palm trees. So it's possible we could find ourselves in a recession, and home buyers right now have the opportunity to take advantage of amazing appreciation of value in the short term and still have the ability to potentially take advantage of savings over the long term through refinance. Now, if you have questions, you want to talk about what this all means to your personal scenario, every home buyer, every homeowner, they have their own personal financial scenario. And so whether or not this is the right fit, the right strategy for you, that could be different for everybody. So I want you to reach out if you have any questions. You got my contact number there. Feel free to comment down below. I can happy to answer any questions for you. But let me know, reach out to me and we can chat and talk about your specific scenario. Now, real quick, get into a couple other things before I wrap up for the day. The rate hike. The Fed, last week increased the Fed funds rate by 0.25%. And so what does that mean? A lot of times you hear in the media, oh, 0.25%, everything that you do now is going to be more expensive. And some of that is accurate. The Fed funds rate is your short-term lending rate, it's your overnight lending rate. A lot of times banks are borrowing from, between each other at the Fed funds rate, the overnight lending rate. The Fed funds rate does not have a direct impact on mortgage rates. Mortgage rates are dictated by the trading of mortgage-backed securities, aka mortgage bonds. But the reason that the Fed funds rate does have an indirect impact on mortgage rates is because the Fed funds rate has an impact on our economy, and our economy has an impact on mortgage rates. The Fed increasing the Fed funds rate is designed to combat inflation. You've heard me talk about inflation. It's running rampant. We're at 40-year highs. The Fed's got to do something. They've got to use some monetary policy to try and combat inflation. And so one of those methods is by increasing the Fed funds rate. So that way they can try and curb inflation. Now, my personal opinion, 25 basis points, too little, too late. We heard Jerome Powell come out yesterday and talk about that the Fed may need to be more aggressive at upcoming meetings. And so it wouldn't be surprising to see at the next meeting for the Fed in May that maybe we get a 0.5% increase in the Fed funds rate. But May's a long ways away. We're not even out of March yet, so a lot can happen between now and then. And so if the Fed gets more aggressive, two things that they can do. One, they can increase the Fed funds rate at a faster pace. And number two is the Fed can start to reduce their balance sheet. The Fed has been buying assets, treasuries, and bonds, including mortgage bonds, and they've been holding those. Well, if they start to reduce their balance sheet, if they start to sell these treasuries and mortgage bonds, especially in larger quantities, then that has the ability to hurt interest rates. Think of it like a stock. Okay, if a stock, let's say a stock, starts getting sold off, a lot of investors are selling off the stock. Maybe it ran up significantly in price, and gosh, we want to take our money, we want to take our gains and sell stock. Well, what's going to happen with that stock price? If you invest in the market, you would know that it's going to go down. And in some cases, if enough is sold, it's going to go down fast. And so if the Fed starts to sell off of their balance sheet, which includes mortgage-backed securities, when the mortgage-backed security gets sold off in volume, the price of mortgage-backed securities comes down. And you've heard me say this before, but the interest rates have an inverse relationship with mortgage-backed securities. So price comes down, interest rates go up. And so the Fed reducing the balance sheet can have a negative impact on interest rates. So the Fed's got to have this fine balance, right? Increasing the Fed funds rate should help interest rates, but reducing their balance sheet could hurt interest rates. And it's going to be interesting over the next 60 days to find out which of those is going to take precedence, is going to come into focus more. So we want to watch that. The impact of the Fed funds rate increase. Ultimately, it impacts anything with a variable interest rate, things like credit cards, lines of credit, in a lot of cases, savings accounts, depositories, a lot of times will increase their interest rate paid when the Fed starts increasing its Fed funds rate, when it starts increasing rates. And so keeping an eye on that. Now, your credit card going up 0.25%, your line of credit going up 0.25%, is that going to put you in financial ruin? It's not. And if the Fed continues to hike rates over the course of the year, it's going to increase that cost for you, but it's not increasing so fast that you can't plan for it. You can't take action on things that you'd like to do to help mitigate your cost. So yes, it has the ability to increase cost for you as a consumer, but it's not at a pace so rapid that you've got to freak out and go take evasive maneuvers and put yourself in a bad financial position to avoid. But again, if you have questions, you want to talk about it, reach out. Is my contact information. Leave some comments. Happy to reach back out to you. All right. Lastly, we already talked about this. I talked, looking ahead, the next Fed meeting's in May, and if they do get more aggressive with the rate hikes, then it has the ability, if that does in fact help curb inflation, then that could help interest rates. At this point, rates are rising at a rapid pace. I'm going to show you a chart here of mortgage-backed securities. Let's pull this up. It is loading. Here we go. Building my interactive chart. Maybe it might be building my interactive chart. Or, here we go. Let's try this again. All right. There we go. All right, this is a chart of mortgage-backed securities. The only thing you need to know is when this goes down, rates go up. So what have we seen for the past, since March 7th? The course of the last, 15 days. We've seen mortgage-backed securities come down. Rates have been rising pretty steadily over the last 15 days, 2 weeks. And so rates are up. What I would love to see is I would love to see a plateau. I would love to see a peak where we see rates kind of level off. If they come down a little bit, that'd be great. But at this point, I would love to see them stop rising at the pace that they're rising. All of this being said, it's still a great time to buy. Rates back in 2009 were 5.5 to 6%. And the fact that the appreciation that you can get by buying over the next several years is going to be so immense that it's still great time to buy. And then if we do in fact see a recession, rates come down, possibly be in a position to refinance, and again, get that short-term equity, massive growth, and then get that long-term benefit with a refinance here down the road, 2-3 years down the road, can set any of you up in a phenomenal financial position long-term. So I appreciate you joining me today. Thanks so much for tuning in to SRT Live with me, your host, Sean Richard. I'll be back next week with another update on the real estate market. Until then, have an incredible rest of your week, and I will talk to you next week. Bye.